Welcome everyone to the quarterly research top picks call. Thank you for joining us. Rob, I'll say this before I hand things over to you. The Q2 performance was nothing short of exceptional, so I'm sure we're very eager to hear some insight into the individual positions and your analyst guidance going forward on those individual positions and any changes in going forward. So thank you for putting this together. And with that, Rob, I will hand it over to you and your very accomplished team. So thank you.
Thank you, James. Welcome on behalf of Echelon Wealth Partners. I am Rob Goff, the head of research. And yes, we are very pleased to introduce our first top pick portfolio video, where we will feature our Q220 and our longer term performance, which you see on the screen before you. Our research team joins you today to present the key bullets for their Q320 selections going forward. As you will see from the screen, we are very pleased with the Q220 and year-to-date gains of roughly 46% and 7.5% during extremely challenging market conditions. As you can see, we have also outperformed both the broader TSX index and the TSX Small Cap Index by 15% and roughly 22% for the year to date. Going further back, we are pleased to highlight that our 3-year and 5-year returns are at 215% and 337% going into 2020. For Q320, we have introduced 4 new names to the portfolio, those being Integra Resources, Well Health, Drone Delivery, and Air Resources. Now, to dive in with each of our analysts, we are very pleased to lead with Doug Lowe on healthcare. Notably, Doug's second quarter pick, PROT, recorded the second highest gain within the portfolio, reporting an impressive 82% gain. Over to you, Doug. Thanks.
Yeah, cool. Thanks, Rob, and thanks for that introduction and that lie that you're very pleased to have me kickstart things here. Much appreciated. Starting with ONTX is actually a good place to start, just because there's an abundance of nuance here on why I would reselect a stock that was actually our worst performer in the previous quarter, and I'm happy to justify that view. So just a little bit of context for those of you who have forgotten, the stock has been our top pick for a few quarters, and in the fullness of that time, it's actually up 20-25%. So we apologize to no one for identifying this as a core holding within a diversified small cap portfolio that wants some weighting in drug development. Last quarter, the company reported highly positive phase 2 data for its lead drug, ATB-346. It's an analog of naproxen that is designed chemically to mitigate the incidence and severity of gastroduodenal ulcers that tend to be associated with naproxen itself. They documented that quite nicely in an earlier phase 1 study that was reported maybe about a year and a half ago, and stimulated much of the interest in the stock in the intervening quarters. So it's always a mug's game to pretend that you know more than the market on directionality of a stock, but much like Copernicus predicting the heliocentric view of the universe 400 years ago, I'm going to assert that I'm right and the market is wrong on this one, mostly because we know from phase 2 performance last quarter that we have a drug here in 346, and that's before contemplating the diversity of pipeline that can flow out of the company's hydrogen sulfide conjugation chemistry that made 346 possible. To be candid, the valuation drivers in Q3 are a little bit fluffy. I have high optimism that the company will be able to consummate regional partnerships specifically for 346, if not for other products in its portfolio. But it's quite speculative as to the timing and magnitude of economics that are germane to partnerships, especially regional ones. We like this story longer term, though, precisely because the market is misdiagnosing the fact that phase 2 data shows us that we have a drug here. The company's next trial will be a phase 3 study that will actually ascertain 346's analgesic properties in a larger, probably longer term knee osteoarthritis study at even lower doses than they've tested in humans to this point. That's a nice problem to have, knowing that your drug is even more potent than you originally thought that it was, and lower doses are absolutely going to mitigate any side effect profile that popped up in phase 2. So, you know, this is a stock I think you can kind of pick away at it at current price levels in and around 38 to 40 cent range. You will not be disappointed longer term. As I say, to be candid, I can't sort of predict with high certainty that you will generate your full 250% return specifically in Q3. But this is a stock for which we have high confidence in eventual approvability and partnership status. And so while the market is misdiagnosing its value, I think this is a good opportunity to be picking up stock at really attractive levels. So that's on team. So shifting to another two stocks that we re-anoint with Q3 top pick status as we did in Q2. So the now renamed CRRX used to be called Centric Health. For those of you that have followed the story during our coverage history at Echelon, did a 20-for-1 share rollback during the quarter. Changed its ticker symbol to CRRX, which was lucky. That's the natural ticker symbol for a company named CRRX. I followed this company back as far back as 2009, 2010 when I was at Versant, and when the company was a more diversified healthcare services play. We endorsed the move to become a focused long-term care pharmaceutical dispensation operation, which they accomplished through acquisition over the years. Most of their Ontario operations arose through the acquisition of Classic Care a few years ago, and their operations in Alberta through acquiring PharmaCare. They recently consummated an acquisition on somewhat aggressive but still reasonable terms, acquiring a company called RemediesRx, which dramatically increased their bed count. So they have now 50,000, we say beds, patients under management for whom they provide pharmaceutical dispensation services. It does make them the largest firm of this type in Canada, we believe, although their peers are, one is the private company Medical Pharmacies, and the other is in a division within Loblaw Shoppers Drug Mart called Medisystem, which I actually covered when I was at Versant many years ago as well, so we've known this space well for a while. We think the company's balance sheet, which has notoriously been an S show for many years, is no longer that. Just consummated an equity offering a couple of months ago that partially mitigated their balance sheet risk, but we believe that they can accretively grow EBITDA both through acquisition and organic growth. Importantly, probably through consolidating administrative and operational costs through the RemediesRx acquisition. It is quite surprising just how many of Remedies operations are almost on the same street as CRRX's operations in Ontario, Alberta, and BC, and there's just a natural consolidation there that can mitigate the cost line for the company. And we think that now that they've achieved reasonable scale, that they should be able to pick off smaller vendors in a challenging funding environment, both in Ontario and Alberta, where they have most of their operations. Should be an opportunity to buy assets a little bit closer to 4 to 5 times EBITDA instead of the 8 and change that they acquired RemediesRx for. Like the management team really well. That has not, in the fullness of time, been a statement that we could say authoritatively, but David Murphy we like, and he's done some really nice work to divest non-core assets and to really focus the company on the RX business. The other thought here that I think is important is that in an environment where multiple EBITDA positive growth companies are going to experience some operational challenges when they report their calendar Q2 and Q3 financial results. The market is just going to become aware of that fact in coming weeks. Do not see that on the horizon for CRRX, which operates in what should be a highly stable healthcare services niche. And their Q2 financial results tend to be historically strong for this core part of their business as well. So we like this stock to perform well over the next 6 to 12 months. Our $7 price target is a real target over a 1-year time horizon. Not that any of other targets are fake targets, but that's a highly achievable price for this story if they post a couple of solid quarters, which we expect them to, over a time horizon that's relevant to our top pick status of the period. And then shifting to ProTech Home Medical, again, another resurrection from our Q2 performance. Rob already alluded to the fact that this stock performed really well in the preceding period. I'd like to pretend I was brilliant on making that call, and anybody that wants to agree with me, feel free for my ego's sake. But this was a story that almost screamed out from the mountaintops that it was going to perform well in the quarter. For those of you that don't know or haven't read our research on this name, it provides home healthcare-based respiratory medical equipment sales and distribution. And in an environment where everyone's favorite pathogen is known to confer high morbidity and mortality through the lung infection and the respiratory distress that is incurred as part of COVID-19 infection profile. It was pretty clear that a company that's providing respiratory equipment into that market was at least going to provide stable revenue, if not experience some growth. Both happened when the company reported its fiscal Q2 financial results. It has a September year end, and we see no reason why the company can't continue to post solid financial results just based on being the right company in the right place at the right time in an important healthcare services niche. Company claims that it can grow by acquiring some of its smaller vendors and bring its EBITDA margins north of 20% and be sustainably at that level going forward, probably achieving that through cost containment, through EBITDA cost synergies. It'll be important that they make acquisitions, as with CRRX, that will closer to 4 to 5 times EBITDA than to 8 or 9. They have a history of doing so, even just within our coverage history through the acquisitions of Cooley and Acadia late last year. And so we like the management team a lot. As I say, they're in the right space at the right time. We see EBITDA margins reaching and then exceeding 20%, perhaps as I think this quarter would be a little bit aggressive on that theme, but for a 1 year time horizon, we see that as transpiring. I think every time they make an acquisition on whatever scale, whether they be Cooley or Acadia-like levels or somewhere in that range, they've indicated that they have their eyes laser focused on businesses that they're generating 4 to 12 million in trailing 12-month revenue. Cooley and Acadia satisfied that criteria. The next time they make 1 or 2 acquisitions of that scale and scope, I think will stimulate the market to realize that we are right on the stock being a 250 stock, and the returns will transpire as a consequence. It's still a stock that can't quite get out of its own way on valuation. This is a story that just one day you're going to wake up and it's up 50% and you didn't even notice. While it continues to be somewhat bandwidth constrained in the $1.10 to $1.20 range, dramatically up from obviously when the calendar Q2 started, when we ascribed top pick status to the stock. Just on, we're not ascribing aggressive multiples to get to a 250 price target. And, as the company continues to exhibit strength through stability, I have to edit that out. I think this stock should too be a core holding for any diversified portfolio that wants some weighting in healthcare services. This, one of its peers, Biomed, is another story that we like but don't cover. But there's more upside from PROTEC just based on its compressed valuation levels. So, Rob, that's our babbling on our world. So that's PROTEC, CRRX, and ONTX. That's reestablishing Q2's performance here. But obviously nothing to be embarrassed about within our healthcare top picks from last quarter. Thanks.
Now, turning to telecom and technology-related coverage, alongside with Amory Zat, we have 4 names in the portfolio. But we'll be speaking to 3 of those, given that we are restricted on 1 of those names. To lead, I will be speaking to Well Health Technologies, where we have a speculative buy rating and a 350 price target, followed by Acquisitive Technology, where the shares are also speculative buy rated, and our price target is $1.40. It's not by coincidence that both stocks are positive benefactors from COVID-19. In the case of Well, the pandemic has accelerated the adoption of telehealth by 3+ years. For the company, Well Health is aggressively building out a network of clinics and a platform of digital healthcare capabilities. Our bullish view considers the following, and this has to do with the acceleration of the marketplace. Regulators have approved billing codes for telehealth. That is a first step towards the establishment of a marketplace there. Second point, patients are looking to physical distance. a second consideration behind telehealth. And thirdly, physicians. They have billing rights, a key thing, and they too, in many cases, are looking to physical distance. So we don't think that it is by any means a stretch, and conversely think it's conservative to say that the pandemic has accelerated the industry by 3+ years. Now, our view on WELL is pretty straightforward. First point, it's exceptionally well managed by a team with a history of success in making money for investors. Or number two, we see the organic growth through an emerging billion-dollar telehealth marketplace. And thirdly, on non-organic growth, we see acquisition growth on accretive terms, where we see a significant consolidation of the clinic market as the traditional low-margin, physical-only model fades quickly to be replaced by an integrated physical-virtual model providing new services and new efficiencies enabled through automation. So for us, a solid name with aggressive forecast returns. Our next name on the slides is Quisitive Technology. Now, the company has a core IT services capability where it is very much aligned with Microsoft, and in fact was named Microsoft's North American Partner of the Year for 2019. And as we look at the IT services area, we believe that Microsoft's CEO set the stage for the space with his Q1 comments when he said that Microsoft had experienced 2 years of digital migration in the 2 months of the quarter. We believe that the stellar performance of Microsoft, Amazon, Google, and the peers speak to the migration to a digital cloud-centered economy. We further believe that the interest of private equity as buyers of IT service providers, their actions reflect the growth of the marketplace and the prospects of higher margins as the services take on greater complexity. In the case of Quisitive, it is the company's alignment with Microsoft in general, and in particular with its LedgerPay platform that is the company's key differentiation. We see announcements around the company's next generation payment platform, otherwise known as LedgerPay, as being key catalysts over the near term and transformative over the midterm. I'm now happy to take any questions, or we can take those at the end. Cool. I am now pleased to turn it over to Amory Zat, whose Photon Control had the distinction of being the top portfolio performer in the second quarter, gaining 98%. It is also very telling that Photon remains as Amer's selection. Over to you, Amer. Thank you.
Great, thanks, Rob. Good afternoon, everybody. Let me start by thanking you for having joined us today. As Rob mentioned, we're sticking to our guns and we're sticking to Photon Control. It was my top pick last quarter and the top pick the quarter before that. Like the company is the poster child of what constitutes a quality stock, like healthy and expanding margins, clean balance sheets, zero debt, growing cash due to their exceptional free cash flow generation, best-in-class ROE, ROIC. Our target now is 225, and if you recall during our last quarter's presentation, it was $1.75. So we keep increasing our target as the company outperforms on the quarters. And obviously, if we have it as a top pick, we still think they will deliver monster quarters, and that will give us further upside. Just as a refresher on what the company does, Photon manufactures temperature sensors that are used in the production of microchips. So it's a play on the semiconductor space. And when you think about the long-term drivers here, it's the proliferation of applications such as AI, cloud computing, IoT, the deployment of 5G networks, obviously. These are all helping drive record growth for chips. Plus, obviously, in the age of COVID-19 and working from home, that is driving record demand for servers, which is essentially memory chips. And this more than outweighs like any smartphone weakness that we've been having. So the point we're trying to make here is that this is no longer an industry driven by PC or smartphone demand, which historically was very boom bust. It's still a cyclical industry, but it's supported by long-term secular trends. When you think about chips in general, these chips are getting smaller and smaller and much more complex in nature. Essentially, we're trying to increase processing speeds by reducing the circuit size. So we're packaging more transistors on a single chip. So naturally, the margin for error when you're manufacturing dramatically decreases as we're going to atomic scale. So the need for much more reliable and precise like process controls becomes mission critical, and that's where PHOTON comes in. So the temperature sensors that PHOTON produces are engineered into the equipment that produce the microchips. So they directly have an impact on the yields of players like Intel, Samsung, Taiwan Semiconductor, which manufactures like the Apple chips. So if you overheat or overcool a chip in the manufacturing process, you got Intel or Samsung scrapping hundreds of thousands of dollars of inventory. So that's the quick and dirty on the company and what they do and why we think they're exposed to multi-year secular trends that will sustain earnings growth. Like it's tripled since we've initiated coverage, but earnings growth has been keeping pace with stock performance. And like that's the thing we try to convince a lot of clients is like, wow, like I missed it, it's doubled. Oh, now it's tripled. Like, well, when you look at the multiples, it's trading at 7 times EBITDA, trading at 11 times EPS, which is cheap at any standard, whether you're comparing it to any tech companies in the same domain, historical multiples, and what have you. So still our only topic, we still like it, we're still buyers here. And like Rob and Doug, I'm happy to take questions now or happy to take them at the end.
Okay. Thanks, Amber. And it was your comments about the increasing complexity from longer-term secular growth trends. I took that concept or borrowed the concept and applied it to the IT services, right? Where the movement to on cloud is increasingly complex. And I'm seeing that as supporting secular growth and higher margins reflecting that complexity. So thank you for putting that idea in my mind. Now, I'm very pleased to turn it over to Frederic Blondeau on real estate, where his two names give full consideration to the impact of COVID-19 as well. Frederic, what do you think?
Thanks, and good afternoon. As you are well aware, our sector strategy hasn't changed all that much over the last 8 years, really. Generally speaking, at this stage, we maintain a conservative view with a focus on multi-residential and industrial subsectors, both outperforming in the context of COVID-19. And we continue to favor InterRent, symbol IIP, and CAPREIT, symbol CAR. Both are co-top picks today, while Granite REIT, symbol GRT, and European Residential, symbol ERE, remains our top risk-return ideas. Lastly, I will quickly mention Northwest Healthcare, symbol NWH, and Dream Hard Asset, symbol DRA, as our higher quantitative beta ideas. So in terms of our topics today, first, InterRent REIT, symbol IIP, we would underline that the REIT has a very conservative balance sheet. The REIT's pro forma debt to GBV was a very conservative 27% pro forma post-June 2020 equity offering. And as you can imagine, this is giving them all the flexibility in the world to execute on their development pipeline. We also believe that InterRent has an optimal geographic exposure. As at March 31st, the REIT was the owner and operator of 10,200 rental residential suites, with 85% of the portfolio being exposed to the GTA, Ottawa, and Montreal. So we not only continue to focus on multi-residential in the context of COVID, but also we think that from a pure geographic standpoint, Eastern Canada should outperform Western Canada. And so far, InterRent has only been minimally impacted by COVID-19, as at May 5th, the REIT had collected 98% of rents due for the month of April, and that's in line with a typical month, by the way. And while we're waiting, as you can imagine, more color on the impact of COVID when they report Q2 results. Pre-COVID, InterRent's results were relatively strong, with same-store NOI increase of 8.7% in Q1. So our second cold top pick is Canadian Apartment Properties, symbol CAR. And the REIT as Canada's biggest Ontario-exposed multi-residential platform, and has also a very conservative balance sheet. As at Q1, CAR's debt to GBV was a conservative 37%. The REIT is arguably Canada's dominant multi-residential operator with 55,000 residential suites. And in 2019, the Ontario and Quebec residential suite sub-portfolios generated 47% and 17% of total operating revenues, respectively. So again, so far the REIT has been only minimally impacted from COVID. As on May 15th, management stated that the REIT was able to collect 98% of rents due for the month of April. That's essentially in line with the March rent collections, and management was not seeing back then meaningful changes in trends for the month of May. So again, I mean, we're still waiting for more color on the impact of COVID when they report Q2 results. But pre-COVID, again, CAR's operating numbers were very strong, notably with a same-store NOI increase of 5.7% in Q1, and that includes a 7% increase from the Ontario sub-portfolio and almost a 10% increase from the Quebec portfolio, respectively. So again, in the context of COVID, we remain very conservative, and we think that demand for apartment or rental units should remain relatively strong. And the reason why we like industrial is the same reason why we kind of stay away from retail at the moment. As you can imagine, I mean, e-commerce continue to gain market shares there, and the malls continue to suffer. So I'll leave it there for now, and I'm happy to take any questions.
Okay. And I'm now pleased to turn it over to Andrew Semple, our Special Situations Analyst, where Andrew has two cannabis names. Welcome, Andrew.
Hi, thank you, Rob, and hello, everyone. I'm here to speak about my two cannabis top picks for Q320. Those top picks are Air Strategies and Green Thumb Industries. Both companies operate in the U.S. cannabis industry, are highly profitable today, and are fully funded for their organic growth plans. We believe the coming quarters and months offer plenty of potential catalysts to lift the share price closer to where we feel intrinsic value is. So I'll start with Air Strategies. Air Strategies is a new addition to our top picks portfolio, and we're excited about the company's immediate prospects. Air owns adult use and medical cannabis operations in the states of Nevada and Massachusetts. In the first bullet on the slides that you'll see on the screen, you'll see that we believe the company has completed an operational and financial rebound. Air experienced some negative headwinds from regulatory actions related to COVID-19, as regulators ordered cannabis businesses closed in both Nevada and Massachusetts. It was unfortunate that Air happened to operate in the two most impacted states in the U.S. cannabis industry. However, we wrote in our top picks report that we believe the company has now fully recovered from this impact. In fact, just days after we published our top picks piece, Air Strategies confirmed our view in a press release, noting that profitability has since improved quarter over quarter, and that it has now reversed all of the Q220 headwinds, at least on the EBITDA line. We're very impressed by this announcement, as it implies the month of June was likely the company's most profitable month in the company's history. And yet, when we look at the share price today is trading well below the $14, $15 range prior to COVID-19. So we think this represents an immediate opportunity for AIR to continue to trend in the near term to repricing to where it was before the coronavirus crisis struck. The company also trades at just 5.1 times our 2020 EBITDA forecast. At 5.1 times this year's EBITDA, that does not seem to reflect a company that offers high margin consumer staples products, is rapidly growing sales and profitability, and which has clearly demonstrated its ability to skillfully navigate a very difficult situation. This discounted valuation, combined with AIR demonstrating its operational resilience, in our mind, we believe this makes it one of the most attractive risk-reward trade-offs in the US cannabis industry. We look for further announcements on growth plans, M&A, and financial and operational updates to lift the share price and act as a catalyst. So I'll move over to Green Thumb Industries, which I will refer to as GTI. GTI is a returning top pick for us after having returned 65% in Q220 and was the best performing large or medium cap stock in the cannabis industry. This is the fourth consecutive quarter that GTI has been a part of our top picks portfolio, and that it has outperformed its peers in all three prior quarters. We don't see any reason for this momentum to slow down, since the company continues to be a best-in-class business while being discounted relative to peers despite its lower risk profile, in our view. In fact, the company is already up, the company's share price is already up 20% since we have nominated it to the Q3 top picks portfolio. The thesis really hasn't changed much at all. GTI is fully funded for its operations, has no pending M&A, and we believe it to be one of the few cannabis operators currently generating positive operating cash flow. GTI operates at meaningful scale in several states, which allows it to achieve profitability far faster than some of its peers, which are not operational in many markets, while also offering GTI diversification benefits. So if I were to summarize the aforementioned points, the company is highly profitable, de-risked, and is growing extremely quickly. The market is not really appreciating the further upside potential. In terms of catalysts, we look for GTI to continue outperforming on operational milestones. We look for the potential for M&A as well as license awards to grow the company's portfolio of assets. Though Q2 results may be somewhat off trend due to COVID-19 related regulatory emergency measures, we believe the financial updates will be broadly positive. Although we are also looking for positive data points from key markets such as Nevada, Massachusetts, Illinois, and Pennsylvania, which should further fuel share price growth. With that, I'll take questions on GTI and AIR, or happy to take questions at the end of the call.
Thank you very much.
Yep, thank you.
To precious metals, I am very pleased to turn it over to Ryan Walker and Gabriel Gonzalez.
So this quarter, we are replacing Wesdome, which has been a fixture on the top picks list mostly for the last couple of years, deservedly so. It's up, I think, about 300% in the last 2 years. But we are switching to Integra Resources, where we have a spec buy 725 target. It's currently trading around 560, and that's a little bit different than what you see on the screen, as that reflects quite a recent share consolidation that just hadn't been incorporated as of yet. So Integra shares were up an impressive 123% during the first quarter, mostly on gold price strength. Really not any news out of the company that was pushing that, but we think there is some more upside left, and we'll get into that in a second. Firstly, just kind of in a general sense, Integra really has all the attributes we look for in a company. A large and growing resource. They've got 4.4 million ounces of gold equivalent at their Delamar project in Idaho. But on top of that, they got a lot of exploration potential remaining, and that's what this year is going to be all about. Second situation in Boring, Idaho, nice, stable, mining-friendly jurisdiction with obviously first world surrounding infrastructure. And then three, and probably equally as if not more important than a nice resource, is a top management team to really further that project and develop it. Here we have George Salamis as the CEO. Some of you may remember him from the first iteration of Integra, where he sold that company to Eldorado Gold for $590 million back in 2017. So a nice win under his belt among many others, and really George doing a great job with the second iteration of Integra. And I would note here that George has already brought in a mid-tier strategic investor in Core Mining for a 5 or 6% equity interest. So a nice endorsement of the project and the management team at Integra, but small enough that it doesn't eliminate competitive tension going forward. So our thesis for Integra as our Q3 pick, pretty simple. The company's recently launched an aggressive 16,000 meter drill program at Delamar in Idaho, with the potential for some high impact results in obviously finally a buoyant gold market. So on the Florida Mountain portion of the project, drilling there is really initially aimed at fleshing out some higher grade historically mined veins dating back to the 1800s. The old timers basically would mine what they could see and what was right in front of their nose, leaving behind some material along the margins of these veins, which just wasn't worth their time. But this material runs 7 to 10 grams, which these days is considered pretty high grade. So they're going to get in there and drill off some of this material and see if they can trace it along trend and along the veins, and really try and build some ounces that way. And at those kind of grades, it doesn't take much to really start building ounces. Drilling there will also target a large geochemical anomaly. So a little bit earlier stage, but the important thing here is that this anomaly is immediately adjacent to existing resources and about the same size and hasn't been drill tested. So, if you want to do some arm waving, potential to possibly double resources there with obviously some drilling to get that into a resource, but definitely the potential there with a nice large strong geochem anomaly. And elsewhere on that portion of the land package, they'll follow up on some higher grade drill results that they released at the end of last year, and some other chemical anomalies nearby. But really, it's that high grade stuff that the old timers left behind in this very large geochem anomaly that really mirrors the existing deposit at Florida Mountain. Those are the key things for the program there. And then at War Eagle, which is another portion of the broader Delamar land package, again, is going to go after some high-grade zones adjacent to some results that were reported late last year, which included up to some multi-ounce material, gold and silver. The highlight there, a 4.3 meter section of just about 74 grams per ton gold and just over 800 grams per ton silver. So definitely worth following up. And really, at both Florida Mountain and War Eagle, the drilling of these higher grade targets is aimed at fleshing out the sulfide component of the project. Most of the existing resource, 4.4 million ounce resource there now, is oxide. The company put out a PEA last year, very robust numbers on mostly that oxide. There was a small component of sulfide toward the end of the mine life, very small operation, really just scratching the surface there. So that's why we think that these impending drill results could be high impact. If you can start to demonstrate more sulfide at these higher grades, it could really have an impact on the economics in that PEA. So like I said, simple thesis for Q3 pick. Resource growth via the drill bit. Company's done it before. We expect them to do it again. Already a large resource, already a mid-tier in there, endorsing the project. So definitely worth following Integra in Q3. And that's it for me, if there's any questions. Okay, if not, I will pass it along to my partner, Gabriel Gonzalez, with his top mining pick for the quarter. Take it away, Gabriel.
Thanks very much, Ryan. I'm sticking with Revival Gold for my Q3 top pick. This is because of the stock's momentum from Q2, where it returned nearly 80%, and because of what I believe will be continued momentum in the price of gold through Q3, which should continue to support the junior mining sector. Revival is already up about 20% so far in Q3, so already some indications of good performance to come. I should note that the US government just passed a comprehensive update to the National Environmental Policy Act, which is expected to streamline a lot of the environmental permitting procedures in the USA and make it less costly and more timely to obtain permits for things like mines. This is certainly positive for the mining industry overall, and it should give greater certainty to moving projects forward, even in already very good jurisdictions like Idaho, where Revival operates. Catalyst-wise, the company will be doing some drilling at Arnett Creek this summer to expand the oxide resources there. That will be ahead of the heap leach PEA expected in Q4. And that should prove to be a fairly high return, relatively low CapEx option, given the existing infrastructure at site. This will provide a better picture of the kinds of cash flow that the company could generate in a near-term production scenario. I also believe that there is continued resource growth potential at Bear Track Arnett as well, and we could see some early indications for that growth through the geophysical work that the company will be doing this quarter. The company has about 3 million ounces in resources right now, and I think it has potential to go very well north of that through further exploration. The company is fully funded for its near-term operations, and at whatever point it comes to market, and certainly if the share price stays where it is or goes even higher, shareholder dilution will be minimal relative to where it would have been only 6 months ago. So I think that should also support the share price through Q3 as well. And I'll leave it at there unless there are any questions. And if not, thank you very much.
And Gabriel, feel free to make note of your video interview with Hugh.
Yes, thank you very much for that, Rob. Yes, we recently published a short video with Hugh Agro, the CEO of Revival Gold, and it's about a 15-minute segment that gets into the project and introduces the project to investors who have perhaps not heard of the story before. So that's on our YouTube channel as well for investors interested in the story to take a look at.
Thank you, Gabriel, and thank you, everyone. On behalf of the research team, we would like to thank everyone for their attendance. We would encourage you to reach out with any follow-up questions or by call, by email. We are here to discuss. So with that, we thank everyone. Unless there are questions that are coming in, we will call it at that. Thank you, everyone. Have a good one.